First, one quick thing. I agree with you, Xavier, that there is these other papers on asymmetric information and bubbles, which are very interesting. And in fact, I do teach them in my course, and I know them. But the reason I was excluding them is because they're so far away from being practical in terms of being able to put them in a macro model. They are like examples which are very suggestive, intuitive of phenomena that I'm sure are important, but I don't even know how I would put them in a macro model right now. I want to talk about some of the issues that you raised on the systemic and the question of that Francesco also raised about the effects of the bubbles. In any model or in any way that we think about bubbles, they're basically wealth shocks. Change your mind about what the future is or asset prices are. There are many equilibria, these prices fluctuate, and there are positive and negative wealth shocks. And the question is a little bit how these wealth shocks play out themselves. What is truly amazing, and this is one of the things that I'm exploring now, and I think it's a crucial issue, is the issue of why the internet bubble and the housing bubble are so different. If you look at estimates of wealth loss, first, don't trust them. But after saying you that, let me say something. For example, not estimates of the IMF of the wealth loss implied by the bursting of the housing bubble. I'm sure that they have been revised upwards now, but we're like about 1.4 trillion, something of that sort. Wealth estimates, the estimates of the wealth shock that came together at the time of the Nasdaq, of the loss in wealth in the Nasdaq, are about 5 trillion. So even if they revise them upwards, we're at best talking about half the shock, perhaps a quarter of the shock. We're not going to revise them to the point in which we're going to say that the housing bubble collapsing was a wealth shock that was larger or substantially larger than the one in the stock market before. So what's the difference? So understanding what's the difference is crucial. And I think that it's, when you talk about systemic risk, is a crucial thing. And the crucial thing is about how, one of the things that comes to mind when asking these questions, which I think are the right questions to ask, is the issue of the design of the financial system. Not only the question of incentives, but the type of markets that we want to have. I think that the key difference between the two episodes is that we are now in a position of a debt overhang problem, a very big debt overhang. Let me tell you. Imagine a world where most of the intermediation is done through stock markets. I own a stock, whatever, I go to the stock markets. If a bubble collapses, I lose that, but that's not going to affect future intermediation. If there are new guys with new ideas and new savers with new savings, they will issue new stock and so on. There might be issues that come from the fact that that might affect my beliefs, or I might update. Of course, there are going to be channels through which it happens, but they're not going to be direct. Now, if you do the intermediation through banks, what happens? If the banks are the ones that have the losses vis-à-vis the previous ones, now new savers come, new investors want funds, but nobody wants to use the banks because the banks owe money to the previous guys, or they have losses. So it's a typical debt overhang problem. It's a typical in which it's going to be a profitable situation to intermediate that loan if there were somebody else that wants on those profits. And I think that we are immersed in that situation. So it is crucial in the design. If we are in a world where this situation of bubbles are going to continue happening in the last, I think that we have to reduce the banking system and go towards more market-oriented ways of intermediation, like stock markets, or having firms that, for example, a firm could buy a house, sell stocks on that house, and so on. You don't need to have those on mortgages or sell stocks on the house, and would avoid all these sort of situations. So I don't know exactly the details on how to do that, but I think that this is a crucial question, and I totally agree with you. And to find out, once we understand that we are in a world where there's going to be these wealth shocks, so we're going to have moments in which the wealth just expands with all the nice things that this happens, more investment, more consumption, we all feel very happy. But wealth is going to collapse as well. We have to put in the models and so on, but we need to know how to do it. We need to think about what are the impacts of these collapses in wealth and how the design of the financial system tells about that. And I think this is one of the main messages of comparing these two shocks, which are, if anything, much larger the well shock that happened in the internet bubble.